Chapter 5 from KESO Intermediate Accounting, 16th edition, covers the balance sheet. Part 1. What we should know about the balance sheet. It's also called the Statement of Financial Position. It reports assets, liabilities, and equity at a specific date, shows readers the resources, obligations to creditors, and equity in net resources of a company, and it provides supportive information to determine the timing, possibly, of future cash flows. Now, what are the benefits or usefulness of the balance sheet? We can use it to compute rates of return. We can evaluate the capital structure. We can assess risk in future cash flows, and through ratio analysis, we can assess liquidity, solvency, and financial flexibility. What are the limitations? Most assets and liabilities are reported at historical cost. This is slowly changing as we try to merge with the international standard, but we still report PP&E at cost. There are also a lot of estimates like allowance for doubtfuls or warranty reserves or contingent obligations. Also, many items of financial value are omitted, like key employees. Now, balance sheet classifications, because we do ratio analysis, we have to break it down between current and non-current. So for assets, we have current assets converted to cash within 1 year of the operating cycle. And then we'd have non-current, and we'd break that down between investments, PP&E, intangible, and other. Liability and equity is a little easier. We would have current liabilities, non-current liabilities, and stockholders' equity if we're a corporation, and owner's equity if we're a sole proprietorship. A classified balance sheet helps informed users determine working capital and do ratio analysis. Now, how do we value them? Because of our convergence with the international standard, now cash and cash equivalents are shown at fair value, recognizing any unrealized gain or losses on the income statement for short-term investments held for under 3 months. Receivables are net receivable value because we estimate how much we want received as part of allowance for doubtfuls. Inventory is valued at lower of cost or market, and prepaid expenses are always at cost. Now, let's take a look at this adjusted trial balance and see if we can prepare a balance sheet. Now, this is an adjusted trial balance, and we're going to assume that the retained earnings already reflects adjustments for net income and any dividends, and we will check off items as we use them, and we're going to start by looking at all of our current assets. So, of course, the number one is cash, accounts receivable, allowance for doubtfuls, inventory, and we look down the line. Do we have any others? Yes, we have a prepaid account. Now we can do current assets. So we go back to our balance sheet and we show assets. Then we isolate current and we list our cash, our accounts receivable net, inventory, and prepaid expense to get our total current assets. Now we're going to move on to the other categories of non-current assets. So non-current, they're going to be more than 1 year. Examples might be securities, tangible fixed assets, special funds, and non-consolidated subsidiaries. That means we owe more than 20%, less than 50%. So now we're going to check off any non-current assets. And we're going to start with anything that we would consider investments. So we have this long-term investment. We have land that we bought as an investment. And we have our cash surrender value of our insurance. Now we can do our non-current assets starting with investments. And we would list our long-term investment, our land, and our cash surrender value of our insurance. And now we have a total for that. So now we move on to our next section, which is property, plant, and equipment. So what we're going to do is look at this adjusted trial balance for any buildings, equipment, or accumulated depreciation. So let's check them off as we go. We have building, we have equipment, and we have accumulated depreciation. Now we can do our PP&E section. And we can list our equipment, our building, and subtract out accumulated depreciation. And now we're going to look to see if we have any intangible assets. So we're going to take a look down this, and we look to see, do we have any intangible assets? And yes, it looks like we have goodwill. We're going to check that off. And now we can do the last section of assets. And so now we have our total assets, and we know now, if we've done this correctly, that when we do our liabilities and equity, it should equal $2,178,000. So we're going to break down liabilities between current and non-current using the same criteria. And in addition, for the non-current, we have to list in the notes to the financials any covenants or restrictions. So we're going to first look for non-current liabilities. For our current liabilities. And that would include our accounts payable, our long-term notes payable that's due next year, and our rent payable. Now we can go to the current section of liabilities. And we would list our accounts payable, our rent payable, and our long-term note payable that's due next year, which gives us total current liabilities of $309. Now we can look for our non-current liabilities. So we have a bonds payable, a premium on bonds, and a pension obligation. Now we can go to the non-current liability section. We would do our bonds payable plus our premium, which means that people paid us more than the face value of the bonds. And we then add in our pension obligation, and now we know our total liabilities. Now we can do our equity section. Owner's equity. The breakdown is capital stock at par value, then additional paid-in capital. That's what we receive in excess of par or stated value. We would show our retained earnings, which is prior year earnings adjusted for dividends. We would show our accumulated other comprehensive income. This is from prior years. And it would be plus or minus depending on what's happened. Then we would subtract out our treasury stock, and then we would have our non-controlling interest, which we add back in. Now we're going to look at for equity accounts. We have common stock, we have additional paid-in capital, and we have our year-end adjusted retained earnings, as I explained previously. Now we can do the stockholders' equity section. We would show our common stock, our additional paid-in capital, our retained earnings, and we equal. And since these two are the same, we know we have done our balance sheet correctly. And that ends part 1 for this chapter 5.